Imagine saving significantly on your capital gains taxes just by being strategic about how you sell your stock. Sounds appealing, right? This isn't just a whimsical thought, it's a tangible possibility with the FIFO method, which stands for first in, first out. The FIFO method is a principle used in accounting where the first goods, or in our case, stocks purchased, are the first ones to be sold. This approach can be particularly beneficial for stock traders, especially those who have held onto their stocks for over a year. Here's why. Under the US tax code, long-term capital gains, those on investments held for over a year, are taxed at a lower rate than short-term gains. So if you've held onto a stock for more than a year, selling it using the FIFO method can potentially lower your capital gains tax to a 15% rate. That's right, just 15%. Now you might be thinking, well, I've never had the option to choose how my stocks are sold. But here's a little secret. Most brokerages do allow you to specify which shares of stock you want to sell. It might require a few extra clicks, but it can make a world of difference to your tax bill. So, how exactly does this work? Let's say you have 100 shares of a stock like Apple that you bought at different costs. How can the FIFO method come into play here, and how can it potentially save you money? Now, let's dive into this example to make this clearer. Let's delve into the scenario. Imagine you've accumulated 100 shares of Apple stock over the years. The first 50 shares were bought 2 years ago at $100 each, and the remaining 50 were purchased a year ago at $150 per share. Now Apple's stock price has skyrocketed to $200 and you decide it's time to cash in on your investment. By using the first in, first out or FIFO method, you decide to sell 50 of your shares. But which 50? According to the FIFO method, the shares that you bought first are the ones you sell first. So you sell the 50 shares that were bought 2 years ago at $100 each. Now here's where the magic happens. Because you've held these shares for over a year, the profit from their sale qualifies as long-term capital gains. This means that instead of being taxed at your ordinary income tax rate, you're taxed at the long-term capital gains rate, which could be as low as 15%. Just by using the FIFO method, you've effectively lowered your tax bill. What's more, you've maximized your profits because the shares you're holding onto are the ones that were bought at a higher price. In other words, you're selling high and keeping high, a surefire strategy for wealth accumulation. As you can see, the FIFO method can be a game changer. But how do you implement it? You might be wondering, how do I apply this FIFO method? Well, you're in luck. Let's delve into the practical side of things. Most brokerages, in fact, allow traders to specify which shares of stock they want to sell. Yes, you heard that right. You actually have the power to choose. This was something I discovered not too long ago. I recently just found this out as most brokerages do allow you to specify which shares of stock you want to sell. You do have to hit a few more clicks to achieve this, but it goes a long way. Now, you might be thinking, a few more clicks, really? Trust me, it's worth it. Here's why. When you sell your stocks, your brokerage will typically use the default cost basis method, which might not always be the best approach for your tax situation. However, by specifying the shares you want to sell, you can strategically implement the FIFO method to your advantage. So, how do you go about this? It's simple. When you're about to make a sale, rather than just confirming the transaction, look for an option that allows you to choose the specific shares. This option can often be found in the Advanced or Additional Options section of your selling page. Once you've located this, you can then select the shares that were bought first, hence implementing the FIFO method. Remember, the goal here is to hold on to your stocks for over a year, so you can enjoy the lower capital gains tax rate of 15%. By being a bit more proactive and taking those few extra steps, you can potentially save a significant amount on taxes. It's all about being smart with your investments and understanding the tools at your disposal. So, with a few more clicks, you can potentially save a lot on capital gains taxes. Take control of your investments and let the FIFO method work in your favor. It's your money after all, make the most out of it. And there you have it, a simple, effective way to potentially save on your capital gains taxes. Let's quickly recap. We've learned how the first in, first out method, aka FIFO, can be a game changer for your stock trading strategy. With the power of FIFO, you can strategically sell your stocks, specifically those held for over a year, to lower your tax rate to just 15%. Pretty amazing, right? Remember our Apple shares example? We walked through how you can specify which 100 shares to sell, helping you strategically manage your investment. As I recently discovered, it's just a few more clicks, but it goes a long way. It's all about being savvy and strategic, and that's exactly what we're here to help you with. Thank you for watching. If you found this video helpful, please subscribe and help us out with the YouTube algorithm. And if you enjoyed this, you'll definitely want to check out our other video on similar stock trading strategies. Stay savvy, stay strategic, and see you in the next video.